The man standing in front of you at the gas station, paying for his coffee with a card that says Business Platinum, made more money last year than most Silicon Valley engineers. He didn't build an app. He didn't raise venture capital. He didn't pitch investors in a glass conference room while wearing a hoodie that cost more than your rent. He owns 3 units of a franchise so unglamorous that when people ask what he does, he changes the subject at parties. That's the joke hiding in plain sight across the entire franchise industry. We've been trained by movies, by LinkedIn, by every 10 under 30 list ever published to believe that wealth wears a certain costume. It's sleek, it's disruptive. It has a logo designed by someone in Brooklyn. It gets written about in magazines with words like unicorn and visionary splashed across the cover. But wealth, real, boring, compounding wealth, rarely looks like that. It looks like a guy in a polo shirt with his company's name stitched over the pocket, driving a work truck that's seen better days, quietly clearing $500,000 a year while nobody claps. Here's the uncomfortable truth nobody wants to say out loud. Prestige and profit are not the same thing. In fact, they're often inversely related. The businesses everyone wants to start, the sexy ones, the ones that sound impressive at a dinner party, are usually the most crowded, the most competitive, and the most likely to bleed you dry before they ever pay you back. Meanwhile, the businesses nobody brags about are frequently the ones with the fattest margins, the least competition, and the most predictable cash flow in the entire economy. Why? Because prestige attracts competitors, and competitors kill margins. Every ambitious 25-year-old with a laptop wants to build the next app, open the next boutique coffee concept, launch the next fashion brand. Nobody dreams as a kid about owning a fleet of trucks that clean out grease traps behind restaurants. Nobody puts portable toilet rental on their vision board. And that's exactly the point. When an entire industry is unglamorous enough to repel the dreamers and the ego-driven, what's left behind is opportunity, sitting there unclaimed, generation after generation, because almost nobody is willing to swallow their pride long enough to pick it up. There's a concept in economics sometimes called a dignity tax, the invisible cost people pay by avoiding profitable but unglamorous work simply because of how it looks to others. You pay that tax every time you choose the business that photographs well over the business that pays well, and most people pay it their entire lives without ever realizing there was a toll booth at all. So today, we're going to walk through 10 franchises that will never trend on social media, that will never get you compliments at a networking event, that might actually make a stranger's face twist slightly when you tell them what you do. And every single one of them has the documented potential to clear over $500,000 a year in revenue for the people willing to run them seriously. Some of these will surprise you because they're businesses you interact with constantly and never think twice about. Others will surprise you because of exactly how much money is quietly moving through an industry that looks from the outside like it's barely surviving. And one of them, the very first one, is a business so unremarkable in appearance that the owner told me he's had guests over for a barbecue who had no idea what paid for the house. We're starting there. With a business that smells bad, looks worse, and pays better than almost anything on this list. His name was Danny, and for the first 3 years of owning his business, he lied about it. Not overtly, not with a fake job title on a business card, but through a mission, through vague answers, through the practiced art of changing the subject before anyone could ask a follow-up question. When people asked what he did, he'd say, "I run a service company," and hope that was enough. It usually was. Because the truth, that he owned a fleet of trucks that pumped grease out of the drains beneath restaurant kitchens, wasn't exactly first date material. It wasn't the kind of answer that got you invited to speak on a podcast about entrepreneurship. But it was the kind of answer that, by year 5, had him clearing over $600,000 in annual revenue with 2 employees and a phone that never stopped ringing. Grease trap and hood cleaning is one of those businesses that exists entirely because of a legal requirement nobody chooses to think about until it's too late. Every restaurant, every commercial kitchen, every fast food chain on every corner of every city is legally obligated to keep its grease traps clean and its exhaust hoods free of built-up fat and residue. Skip it, and you're not just risking a bad smell, you're risking a fire. Kitchen fires caused by neglected hood systems are one of the leading causes of commercial fire damage in the food service industry, and insurance companies know it. That's why most commercial policies require documented, regular cleanings as a condition of coverage, which means this isn't a service restaurants might want. It's a service they cannot legally or financially avoid. Now sit with that for a second, because that single fact changes everything about how this business behaves compared to almost anything else on this list. This isn't a business built on discretionary spending, on convincing someone they want something. It's built on regulatory obligation. Restaurants don't cancel grease trap service when the economy tightens. If anything, this is one of the rare service categories that becomes more essential during a downturn, because a restaurant fighting to survive absolutely cannot afford the alternative. A fire, a shutdown, a lawsuit, an insurance claim denied because of a lapsed cleaning record. Franchises in this space typically operate on route-based recurring contracts, meaning a single restaurant might sign on for monthly or quarterly service indefinitely. Danny didn't have to find new customers every month. He had to keep the ones he already had, and restaurants once locked into a reliable vendor almost never switch, because switching means risk, and risk is the one thing a restaurant owner already juggling razor-thin margins cannot afford to introduce. The economics get better the deeper you look. Equipment costs are moderate, not extreme. Labor doesn't require specialized degrees, just training and a strong stomach. And because so few people are willing to do this work, competition in most mid-sized markets is thin enough that a single operator can lock down dozens of commercial accounts before a competitor even notices the territory is being claimed. Danny's route, by his 4th year, covered 11 restaurants on recurring contracts and 4 hotel kitchens on top of that. He wasn't chasing customers. Customers were, functionally, chasing him, because the alternative was finding someone else willing to do a job most people won't even Google. But grease traps are only the beginning of the story. If Danny's business proves that unglamorous doesn't mean unprofitable, our second franchise proves something even stranger. That some of the highest margin businesses in America are built entirely around a single, universal, unavoidable human need. One so basic, so constant, that no economic downturn, no recession, no shift in consumer trends has ever once reduced demand for it. You've used this business's product, probably more than once. You just never once considered who owned the company behind it, or how much they were quietly making from a temporary structure most people try very hard not to look at directly. Every music festival, every construction site, every outdoor wedding you've ever attended relied on it. Every marathon route, every county fair, every stadium overflow lot had rows of it lined up like plastic soldiers nobody wanted to acknowledge. Portable restroom rental is, without exaggeration, one of the highest margin service businesses hiding in plain sight in America, and almost nobody in the industry advertises how good the numbers actually are. Because why would you invite competition into a market this quiet? Here's what makes it absurd. A single unit costs a few $100s to manufacture, and maybe $100 a month to maintain and service. That same unit can rent out for well over $100 a week to a construction site, sometimes more for events. Multiply that across a fleet of 80, 100, 200 units, and you're looking at a business model with margins that would make a software company jealous. Except, this one doesn't need venture funding, doesn't need a product market fit deck, and doesn't need users to get it. Construction sites are legally required to provide sanitation facilities for workers under OSHA regulations. Events need them because nobody's coming back next year if there's nowhere to go. The demand isn't seasonal in the way you'd assume either. Construction never stops needing units, and event season simply shifts the revenue mix rather than eliminating it. Franchise owners in this space frequently run lean, 2 or 3 employees managing routes of delivery, pickup, and cleaning, while the owner spends most of their time doing what actually matters in any service business, managing contracts and chasing the next site. Which brings us to something almost nobody notices until they're staring at a route sheet for the first time. The entire portable sanitation and grease service world runs on the same underlying principle as our next franchise, one that's arguably even less visible, even less discussed, and even more profitable per unit of effort. Vending machines. Everyone's seen a vending machine. Almost nobody has thought seriously about who owns it, restocks it, and collects the cash. And that's precisely why it's still one of the most underrated franchise categories in the entire service economy. The math is deceptively simple. A machine placed in the right location, a busy office building, a hospital break room, an apartment complex with 300 units and no nearby convenience store can generate anywhere from $200 to $800 a month in pure margin, depending on placement, product mix, and foot traffic. Now multiply that by 50 machines, 100 machines. Some operators run networks of 300, 400, 500 machines across a metro area. And here's the part that stuns people who've never looked at the industry closely. Modern vending franchises have shifted almost entirely toward cashless, app-integrated machines with remote inventory monitoring, meaning an owner can check which machines are running low on Diet Coke from their phone without ever driving to the location. The labor-to-revenue ratio in a mature vending route is one of the best in all of franchising because the machine does the selling, the machine does the transaction, and the owner's entire job is logistics, restocking on a schedule, negotiating placement contracts with property managers, and occasionally swapping a machine that's underperforming for a location that pays better. A 2019 industry analysis published by the trade group Automatic Merchandisers' State of the Vending Industry Report noted that successful multi-unit vending operators consistently reported profit margins exceeding those of most quick-service retail franchises, precisely because overhead stays low while the asset itself keeps generating revenue with almost no daily intervention. It's a business built on the same logic as owning rental property, except instead of managing tenants, you're managing snack inventory, and instead of a mortgage, you're managing a fleet of machines that, once placed, tend to stay placed for years. But even vending machines, quiet as they are, still involve visible transactions, someone standing there, pressing a button, watching the item drop. Our next franchise takes invisibility even further. It's a business people actively try not to think about. A business that only crosses their mind in the exact moment something has gone catastrophically, expensively wrong. And when that moment arrives, they will pay almost anything, immediately, without negotiating, to make the problem disappear. The phone rings at 2 in the morning, and whoever answers it knows, before they even pick up, that the person on the other end is having the worst night of their year. A pipe burst, a basement flooded, a kitchen fire spread faster than anyone expected. And in that moment, the homeowner isn't comparison shopping. They're not reading reviews. They're not negotiating. They want someone there, now, with equipment, with a plan, with the calm authority of someone who has seen this exact disaster 1,000 times before. That's the entire business model behind water and fire damage restoration franchises. And it's one of the strangest paradoxes in the entire service economy. A business that gets called in the worst moments of people's lives, and yet operates with some of the most stable, recession-resistant revenue of any franchise category that exists. Think about what restoration actually requires. Specialized drying equipment, certified technicians, direct relationships with insurance adjusters, and the operational discipline to show up within hours, not days. That barrier alone keeps most casual competitors out. But the real secret is who's actually paying the bill. It's rarely the homeowner directly. It's the insurance company, which means restoration franchises aren't fighting over discretionary spending. They're billing against policies that already exist, for damage that's already occurred that the insurer is contractually obligated to cover. A well-run restoration franchise with strong adjuster relationships can pull in jobs ranging from a few $1,000s for a small water intrusion to well over $50,000 for a major structural fire. And because disasters don't check the economic calendar before they happen, this industry doesn't contract during recessions the way retail or hospitality does. Pipes still burst in a downturn. Basements still flood. Houses still catch fire. If anything, some restoration operators report an uptick during economic stress, as deferred maintenance on older homes and properties leads to more failures, not fewer. There's a term economists sometimes use for industries like this: recession-resistant, or in more academic language, non-cyclical demand. Businesses tied to unavoidable human circumstances, illness, disaster, death, decay, tend to hold steady, or even grow, exactly when everything else is shrinking. It's the same principle that makes the next franchise on this list so quietly powerful and arguably even more resistant to economic gravity than the last one: senior mobility and non-medical home care. If restoration deals in disaster, this business deals in the single most predictable demographic shift in American history: the aging of the baby boomer generation. Every single day, roughly 10,000 Americans turn 65. That number isn't a projection or a guess. It's a documented demographic fact tracked for decades by the U.S. Census Bureau. And it's going to keep happening every day for years to come. Every one of those people eventually needs help. Help getting dressed, help remembering medication, help simply not being alone in a house that's grown too big and too quiet for one person to manage safely. Non-medical home care franchises exist precisely to meet that need, sending trained caregivers into homes for a few hours a day or around the clock, billed either privately or through long-term care insurance. And unlike almost any other service business, demand here isn't influenced by consumer confidence, inflation, or stock market performance. Families don't decide to postpone caring for an aging parent because interest rates went up. If anything, economic downturns push more families toward home care instead of expensive assisted living facilities, because it's frequently the more affordable option, which means the business actually gains customers during exactly the periods when other industries are losing them. Owners in this space typically manage a roster of caregivers rather than performing the care themselves, which means the business scales through people management and client acquisition rather than the owner's personal labor. A single territory covering a mid-sized city, once it reaches 30 or 40 active clients receiving regular hours of care, routinely clears well past the $500,000 mark in annual revenue, built entirely on a demographic wave that isn't slowing down, isn't reversing, and won't peak for at least another decade. What both of these businesses share is something deeper than recession resistance. They're built on inevitability. Disasters happen, people age, and inevitability, it turns out, is the single most underrated asset an entrepreneur can build a business around. But inevitability alone isn't enough to explain why our next three franchises have become the closest thing the industry has to an open secret. A trio of businesses so ordinary, so unremarkable, so utterly beneath the notice of anyone chasing prestige that almost nobody bothers calculating what a mature location in this space is actually capable of generating year after year, without a single viral moment, without a single press mention, without anyone outside the industry ever taking them seriously at all. Maria opened her third laundromat the same month her daughter graduated from college, and she remembers the exact moment she stopped being embarrassed about what she did for a living. It was at the graduation dinner when her daughter's economics professor, upon hearing what Maria owned, leaned forward and asked a single question: "How many locations, and what's your average revenue per unit?" Maria told him. He didn't say anything for a moment. Then he said, "You're doing better than half my former students who went into finance." That was the moment Maria realized something most people never figure out until much later in life, if ever. The businesses that seem the most beneath consideration are often the ones running the most sophisticated, most durable financial engines in the entire economy. Coin laundry and laundromat franchises are the purest example of a business model economists sometimes call an annuity asset. You install the machines once, you pay for the real estate once, or lease it long term. And then, day after day, year after year, quarters and app payments trickle in from a customer base that has almost no alternative and almost no reason to switch locations once habit sets in. There's no delivery to manage, no perishable inventory to worry about, no staff to schedule for most of the day. A modern, well-located laundromat, particularly one that's added card and app payment systems alongside traditional coin machines, can run almost entirely unattended, with an owner stopping by once or twice a day to empty payment systems and check on machine status remotely through monitoring software. A location doing consistent volume in a dense urban or student-heavy area routinely clears past $500,000 in annual revenue, and because the fixed costs, once the build-out is paid off, stay remarkably stable, an enormous percentage of that revenue drops straight to profit. Industry data compiled by the Coin Laundry Association has repeatedly shown that laundromats maintain some of the highest cash flow to investment ratios of any brick-and-mortar franchise category, precisely because the business asks so little of its owner on a daily basis, while asking quite a lot of a customer base with genuinely no other option. Car washes tell a strikingly similar story, except with an even more addictive revenue model baked into the modern version of the business: the monthly subscription. The old image of a car wash, someone paying $8 for a single wash on a Saturday afternoon, has been almost entirely replaced by unlimited membership programs, where customers pay a flat monthly fee and wash as often as they want. That single shift transformed the entire economics of the industry. Instead of unpredictable, weather-dependent, one-off transactions, modern car wash franchises are increasingly running on recurring subscription revenue that arrives whether or not the customer even shows up that month. The exact same psychological and financial mechanism that makes gym membership so profitable. A single, well-located express car wash, fully automated with minimal staffing, can process hundreds of vehicles a day during peak hours, and once a membership base reaches a critical mass, often several thousand active subscribers for a well-established location, the monthly recurring revenue alone can push well past the $500,000 mark annually, largely independent of how many people actually drive through on any given day. And then there's commercial cleaning, perhaps the least visually interesting franchise on this entire list, and yet one of the most quietly dominant in terms of contract value. Every office building, every medical facility, every school and gym and retail chain needs its floors mopped, its bathrooms sanitized, its trash emptied, every single night, without exception, regardless of what the economy is doing. Commercial cleaning franchises don't sell a product anyone gets excited about. They sell reliability, a service so unglamorous that most business owners never think about it until the one night it doesn't happen. That unglamorous reliability is precisely what makes it so lucrative at scale. A single owner rarely does the actual cleaning themselves past the first year or two. Instead, they manage a portfolio of commercial contracts and a rotating staff of cleaning crews, essentially running a logistics and labor management operation disguised as a janitorial company. Larger territory owners in this space, managing a roster of dozens of commercial accounts, routinely exceed $500,000 in annual revenue, built entirely on contracts that renew automatically, year after year, because switching cleaning companies is exactly the kind of minor operational hassle most businesses would rather avoid than pursue. 3 franchises, 3 completely different services, and yet all 3 share the same underlying architecture: low daily involvement, high customer retention, and revenue that keeps arriving whether the owner is actively working that day or not. It's the exact opposite of what most people imagine when they picture a hustle, and that's precisely why it works. But we've saved the strangest one for last. Our 10th and final franchise isn't unglamorous because it's dirty, or because it deals with disaster, or because nobody wants to think about it. It's unglamorous for a completely different reason, one that's almost funny once you understand it, because it looks, from the outside, exactly like a hobby, like something a retiree does for fun on the weekends. Nobody suspects it's capable of the kind of numbers we're about to walk through. Frank was 61 years old, recently retired from a manufacturing job, and looking for something to do with his hands that wasn't just yard work. He bought a used golf cart for $200, fixed it up in his garage over a weekend, and sold it for $600 to a neighbor who saw it sitting in his driveway. That was the entire origin story. No business plan, no pitch deck, just a bored retiree with a wrench and a garage. 4 years later, Frank owns a golf cart sales, customization, and repair franchise location that cleared over $700,000 in revenue last year, and he still tells people it started as just something to keep me busy. Golf cart franchises might be the single best example on this entire list of a business that hides its profitability behind an image so harmless, so leisurely, so thoroughly unthreatening that almost nobody takes it seriously until they actually look at the numbers. It reads, from the outside, like a retirement hobby. Guys tinkering with electric motors, neighbors chatting over a cart with a fresh paint job. But underneath that harmless surface sits one of the fastest growing, highest margin niches in the entire personal transportation industry, driven by a demographic and lifestyle shift that most people haven't even noticed is happening. Golf carts have quietly evolved from a golf course accessory into a primary mode of transportation across an enormous and growing category of American communities. Age-restricted retirement developments, gated master plan neighborhoods, coastal towns, college campuses, and entire municipalities that have built golf cart-specific lanes into their infrastructure. In some of these communities, a customized, street-legal golf cart isn't a toy. It's the family's second vehicle, used for grocery runs, school pickups, and evening drives, and families are willing to spend anywhere from $8,000 to $25,000, sometimes more, on a fully customized unit with upgraded batteries, lifted suspension, custom upholstery, and audio systems that rival what you'd find in a luxury sedan. The franchise economics stack up in a way that surprises almost everyone who looks closely. Unlike a traditional auto dealership, overhead stays low. No massive showroom, minimal specialized labor certification requirements compared to standard automotive repair, and a customer base that skews toward cash purchases or straightforward financing rather than the complex loan structures of traditional car sales. A single location combining new and used cart sales, customization work, battery replacement services, and ongoing maintenance contracts can build a revenue base from 3 separate, reinforcing streams simultaneously: sales, service, and accessories, each feeding referrals into the other 2. Industry tracking from IBIS World and various franchise trade publications has flagged golf cart and low-speed vehicle retail as one of the fastest-growing small vehicle categories over the past several years, driven largely by the explosive growth of 55-plus retirement communities across Sunbelt states, a demographic wave that, much like the home care franchise from a few chapters back, isn't slowing down anytime soon. Frank's version of the business, at full maturity, runs a service bay in the back, a small sales lot up front, and a customization shop that stays booked out weeks in advance during peak season. He employs 4 technicians. He shows up most days, not because he has to, but because, in his words, "It's the most fun I've ever had making money." That single sentence might be the most important idea in this entire list, more important than any revenue figure we've discussed across the last 5 chapters. Because here's what all 10 of these franchises actually have in common. Once you strip away the smell, the stigma, the unglamorous surface details that keep most people from ever looking twice, every single one of them solves a problem that refuses to go away. Grease traps don't stop needing service because a business feels embarrassed to sell that service. Pipes don't stop bursting because restoration work isn't Instagram-worthy. People don't stop aging. Cars don't stop getting dirty. Laundry doesn't stop piling up. And offices don't stop needing clean floors, regardless of how anyone feels about the prestige level of the company handling it. The businesses on this list win not despite their lack of glamour, but specifically because of it. Every dreamer chasing status scared themselves out of the room, and what's left behind again and again is an open door that almost nobody bothers to walk through. Somewhere right now, someone is turning down a profitable, boring, unsexy business opportunity because they're worried about what people will think of them at a dinner party. And somewhere else, someone just like Frank, just like Danny, just like Maria, is quietly building the kind of financial life that dinner party will never come close to matching. The only real question left is which side of that room you're planning on standing in.